the limited
and capturing the more recent developments. In that sense, you won't find anything very dramatic or interesting. Let me start with what I would consider to be the main features of the current policy. First, growth. We feel that the growth is on track, and we expect the year to end with 8.5% GDP growth that we anticipated at the beginning of the year, and we reiterated after 3 months. The one good aspect, that type of growth that has happened, is that the investment demand is continuing, capital goods production is increasing, capital goods imports are increasing, which means that the supply conditions are likely to be better in the future, which means the quality of growth in the future is likely to be better. That is what we wanted, that is what is happening, and that is good news as far as the GDP growth is concerned. Similarly, as far as the growth of non-food credit is concerned, it is more or less according to what we desired at the beginning of the year. The money supply has been higher than what we anticipated, and that is going to be an area where we have to give some attention to. The most important thing has been the huge liquidity, and this liquidity has been induced by large capital inflows relative to our local absorption capacity. Since the absorption capacity does not increase quickly, we have to do something about the whole situation. We have taken various measures. As far as the prices are concerned, again, inflation is the inflationary developments by and large have been on track, and we expect that inflation will end more or less the way we wanted it at the beginning of the year, that is close to 5%, and perhaps by considering the various developments on the supply and demand side, we are closer to what we wanted, 4 to 4.5%, than what we were at the beginning of the year, subject to one caveat, that is oil prices. That's the most important caveat. The oil prices are already ruling high, and the pass-through has not yet occurred. Pass-through may have to occur. We do not know when exactly the pass-through will occur. Subject to this, our expectation is that the inflation will be more or less as per expectations. Inflation expectations also seem to be fairly well anchored. At the same time, we should recognize that underlying inflationary pressures have not disappeared for two reasons. Purely from the domestic side, you have already the oil price hike that has not yet been passed through. Secondly, there is underlying pressure of excess liquidity, which we have to take into account. But more than domestic factors, the risks arise from the global factors. The global factors risk arises on the one hand due to the huge liquidity that has been injected. Also, the food prices are ruling high globally. The oil price uncertainties have increased, the oil prices are elevated, and because of the inflation in China, it is quite possible that the moderating effect of Chinese high productivity and low prices in the global economy may start reducing. So overall, therefore, if at all in the months forward, it is quite possible that inflationary pressures may come from outside to India, and we have to be careful. But otherwise, by and large, we can have some satisfaction that both on the growth side and on the price situation side, the domestic conditions are reasonably stable, barring the issue of liquidity. As far as the fiscal conditions are concerned, the fiscal developments have been reasonable, but there is evidence of some pressure, and therefore we have urged the government to particularly take care of the expenditure management, and that is important. So as far as our monetary policy is concerned, we are proceeding on the assumption that the government of India will be able to